Hey everybody, back with another dividend analysis, and today we're going to be looking at Kimberly Clark Corporation, or KMB. Wanted to look at KMB because I think it's a very good learning opportunity for certain kinds of investors. This is a very template stock for a few strategies, so it's really good to look at, really good to go over, and compare how it works to other companies. So without further ado, let's get started. As usual, we'll start with the dividend yield, currently sitting at about 3.33%. Not too bad, doing about twice, maybe a little bit more than the wide market, the S&P. Not anything to write home about by any means, but a good solid yield. 3% isn't bad, especially in a market that is this overvalued. Next, we can take a peek at the history, and going back to 2013, we could see we were getting 81 cents a share, while we're currently getting $1.14 a share. And if we look back through this history, we can see we're getting 3 to 5 cent increases every year, consistently every year. This is very nice. If you're a dividend appreciation investor, this is what you want to see. The jumps aren't big by any means, but they're decent, they're solid, and they're consistent. 3 to 5 cents every time, up until this year where we got a nice 7-cent jump. But still, considering that the dividend is now, 30% higher than it was, that might make a little sense that the actual real cent value is going up a little bit because the actual percentage jump needs to match what they've been doing in the past. So just keep an eye on those newer dividend increases to see if they go back to those 3 cents or stay around that 5 to 7 cent level. Next, let's go take a peek at the numbers. We can see that last year they paid out just under $1.5 billion in dividends. We'll see how they've been able to support that as we go along. Checking out the cash flow, we can see that the cash flow growth has been very stagnant over the last really 9 years. Going back to 2012, we're at about just over 1.5 billion in free cash flow. We're over 2 billion. So, but we're down just slightly from 9 years ago when it was at 2.2 billion. So very, very consistent free cash flow here. Not a lot of growth. So one thing I'd want to see is if this free cash flow can start sticking around this 2 billion to 2.5 billion point, so that those increases in the future are covered. If it does drop back down to under 2 billion, they might get a little tight on those increases. So look to see if this 5-year average of 2 billion can start creeping up towards 2.5 billion. That's what I would really want to see. Now, if we do our ratio of free cash flow, we can see that they paid out about 66%, 2/3 of their free cash flow as dividends. That's right smack in the middle of our ideal and acceptable ranges of 50 and 75%. So not bad by any means. We'd probably like that to be a little lower. We'd like to see it up at around 2.5 billion, would get us a lot closer to that 50%, but nothing alarming here by any means. Next, let's take a peek at the income. We can see that their income has been pretty much the same as their free cash flow, very slightly up over the last 10 years. Nothing amazing, nothing to write home about. If we do our ratio, we can see our ratio of income is 72.5%, just under our 75% acceptable range. So we really do want to see that income start to increase. We need to get up to what we had in 2020 of 2.5 billion, but we also had a very out of place year there, so that might be difficult. If I'm looking at this, I really want to see this income start to go up somehow. We've been sitting at $2 billion really essentially for the last 10 years. We need more income really to support that dividend, because going forward, we're getting closer and closer to 100% of our income being paid out as free cash flow. So what does Kimberly Clark Corporation do? You probably know without knowing. They make household products, diapers, tissues, some cleaning products, Huggies, for example, Kleenex, for example. A lot of the name brand spoken every day in a lot of households is made by them. A good thing about them is that they are a global company. While they do about a little over half of their business in the U.S., they do have sections in Europe, in Southeast Asia, in Latin America, so they are definitely global. If I'm looking at this, I really want to see how they're going to be able to increase their revenue, increase their income. As we can see, their revenue was down over the last 10 years. There really isn't anywhere left for them to expand to, so it's going to be very hard for them to increase that revenue unless they have new products, do something amazing, they innovate something. So that is something to keep in mind. What you're really going to get here is those dividend increases and those share buybacks. That's where your money's going to come from. If we look at their chart over the last, let's say, 10 years, we can see it's been very slow and steady growth. We were at we jumped from $60 up to about $100, but we've sat for the last 7 years between 100 and 150. This is very slow, very steady growth from a very mature company. It's had very good dividend growth, as we saw. So is this for you? Is it not? I would say if you are a dividend appreciation investor, what this company is doing with their money for its investors is exactly what you want to see. Very slow but very steady dividend increases of about the same amount every year, so that you're getting that yield on cost is going up and up and up. If you're an income investor, this might be something you do. It's a consumer staple. You might combine it with something else, again, like a Pepsi, like an Altria, something like that, to make a nice base, a nice safety net for your income portfolio. For those, if those higher income investments tend to do poorly, things like this shouldn't fall nearly as much, just because people are always going to be buying Kleenex, people are always going to be buying diapers. It's very unlikely this company is going to go out of business in a market downturn. The one issue with them is they are probably a little bit overpriced. Such a large company with declining revenue, having a 23 PE is a little pricey. If they fall back down to this $100 point where they were, during 2018, 2019, I think it would be a really good pickup if you're a dividend appreciation investor. I'm sure this is in a lot of dividend ETFs. I haven't looked, but I'm sure it's in a lot of them. But if you are a dividend appreciation investor, what this company is doing, how it handles its money, is what you should be looking for. Just remember that. This is a very good template for what dividend appreciation should look like. I hope that helps, and thanks for watching.